Hello and welcome, everyone. Good evening. It's so exciting to be with you here again at the 12th, wow, edition of the Startup Compliance series. I am very excited to, be here as your host and also moderator for this session. For those of you that have been with us from the very first session, I just want to say a very big thank you. Welcome to the year 2024. This is actually our first session, although we had another session, although it was not the compliance series where it was in partnership with Africa the Big Deal. So I want to say a very big thank you to the team. But this is our 12th edition of the Startup Compliance series. So what is the Startup Compliance series? It is a webinar or some sort of online education platform that basically helps to educate startups, businesses, founders on legal shenanigans, issues that have to do with government and regulatory compliance, taxes, employment, investment, funding, and everything that goes around it. We bring very experienced minds, both from the legal and from the business, as well as the VC and private equity space, to speak to issues as regards the building of businesses. And I am excited. I'm your host. My name is Rosemond Phil-Othihiwa, and I'm a corporate commercial attorney, and I am privileged to work in the startup space as a corporate governance advisor, trainer, and facilitator. In my capacity at the moment, I mentor with Google in its accelerator, Google for Africa Accelerators program, and I am excited to actually have this session. I have someone incredible. So if you're here and you are watching this from wherever you're joining in the world, I want to say good morning, good afternoon, good evening, good night. Thank you so much for being here. Please feel free to put your comments in the comment sections. Tell us where you're joining us from. This is going to be a very short session, but it's going to be highly impactful. I have an amazing mind that is going to be speaking. We're going to be talking about a very interesting topic, which is a startup's investment and funding life cycle. So, ladies and gentlemen, please make welcome to the stage the one and only Gabriel Olugunwa. Thank you for being here with us. How are you doing today?
Thank you so much, Rosamond. I really appreciate this opportunity, bringing me on your platform. I've been good. I'm doing well. I'm excited to kick this off. Thank you so much once again. Hello to our audience, wherever you are. Thank you guys for joining us.
Awesome. So, permit me to read your profile. I think it's very important that we know who you are. Gabriel Olugunwa is a business group professional turned financial advisor and investor. He is passionate about partnering with value-aligned innovators and investors, bringing economic empowerment to disadvantaged communities on the continent of Africa. Gabriel is currently the founding partner of Plumul Advisory, which is a mission to empower young African entrepreneurs who are leveraging technology to turn the continent's largest and multi-layered infrastructural challenges into profitable businesses and opportunities. He was previously the group head of fintech at Fidelity Bank PLC, where he successfully grew the team's profit from 50 million naira to over 400 million monthly. Wow. Thus earning the award for the highest budget achievement and most valuable team. He was headhunted from GT Bank after his success in onboarding the first crypto exchange platform in Nigeria, which generated over $200 million in additional annual revenues. He organizes free advisory sessions for student founders across campuses and is a sound engineer by passion. Ladies and gentlemen, please make welcome to the virtual stage, Gabriel Olugunwa. It's so exciting having you here. You're such a celebrity. Thank you so much for being on this
Thank
session,
you so
right?
much.
I'm really
Thank,
excited.
thank you so
So
much,
straight
Rosamond.
off the bat, right? I know our listeners are eager. There's so much going on in the startup space. I think there's a phrase that said there's blood on the streets, right?
So much.
Lots of things have happened from
Yeah.
2022 into 2023, and we're in a
Mm.
new year. I remember when I was privileged to speak on national television talking about some of the things that we begin to see in the startup space, and we saw some of them. We saw that, people were no longer excited about valuations and were now looking for companies who
Right.
actually had values and metrics to prove their growth.
Right.
We also saw the
Right.
shutdown of a lot of companies in Africa. We saw the funding landscape literally dwindle to almost a grind. I wouldn't say a grinding halt, but a
But close to that.
slowdown, right? We had
Yeah.
I think about 49% year on year, a quarter on quarter drop from last year. Into Africa, we had about $4.8 billion, and at the end of Q4, with the reports going up and down, we had at least a little bit above $2.8 billion. So you see that it was
Right.
literally half of that, and there's so
Right.
much that goes on. But I'm
Right.
very, very curious as to your role and how you've stayed in this space, and some of the trends, right, that you've seen, and what are some of your, just in a sentence, like what are some of your predictions that you see for the year 2024, right? Because of course we're talking about the startups funding and investment life cycle, and life cycle simply means trajectory of time. So it'd be curious to
Right.
learn about your journey, learn about some of the things that you've seen in this space, and what do you think we should start looking out for before we dive deep into the full conversation. Thank you.
Right. Thank you very much. Like you said, the ecosystem has seen a lot of correction, and every player within the ecosystem has adjusted, whether it's investors or customers or even the founders themselves. Everyone have adjusted to what the new reality is. And to think about it, um, the startup ecosystem is one just unique where everyone expects or places priority on growth and not necessarily on traction or profitability. But with the new demand or focus on traction, profitability, and things like that, everyone has adjusted, and it's a justifiable expectation to have, for all players within the industry. Now, considering that that is the case, um, there is a bit of optimism, even though cautious optimism, for the funding outcomes for 2024. So we expect to see an uptick, even though cautious, but at least an improvement from coming from last year.
Thank you for that. I'm glad that we are. Thank you so much. Thank you for that. I'm glad that
Mm.
there's some optimism,
Yeah,
because I would say last year was a bit bloody.
it
Although
was.
you realize that one of the things that people began to pay attention to, like you rightly said, it was no longer just about vanity metrics.
Hmm.
It was now about putting
Fundamentals.
behind your words. Yes, being able to show workings, and I think that one of the things that you know a lot of financial people say, I don't know whether you join them to say that, you hear the phrase buy the dip. And in the venture capital space, right, usually times where there's not much funding coming in, a lot of
Yeah,
businesses now are trying to use the best that they have to get the best that they can get to. So everybody's
right.
humble now. So the serious
Everybody's
ones
humble.
now are really like putting their houses in order and ensuring that
Yeah,
things are done properly. And then wise investors are looking at the market to see, okay, who are the guys that are still serious that we can take a
right,
bet on. There was
right.
something that I think there was a video that you were featured, and I think it was in the news, and you were talking about what happens when investors keep money for long, because it is in their nature for them to want to plug in funds. So could you
Right.
I think this will lead me to my next question, really. And I think it has to be very, very like specific, right? What are some of the key stages in a startup's funding and investment life cycle, before we start talking about identifying potential sources of funding? So could you just explain to us what does that life cycle actually look like, practically, yeah, from a startup's perspective?
Okay, so there are three key stages: the seed stage, the growth stage, and of course the maturity stage. And yeah, there are sub stages within both each three categories. So in the seed stage, you have the pre-seed and then the seed stage, which is where you're testing your ideas, testing solutions, and be sure there's acceptance. And then you raise funds at that stage, mostly from founders and friends, and then probably relatives. And at the seed stage, um, your idea is already substantiated, again by traction, and then you need funds. You're trying to raise funds to really, power your go-to-market. At this stage, you begin to get in angels, or you get funds, raise funds from incubators, and then one or two VCs if you're lucky. Then you then get to the growth stage, which is where you have the Series A and Series B. At the Series A stage, you already have an established market with consistent customer and revenue base. So now you're looking for funding to optimize that base and double down on the success you're currently experiencing. At this point, you'll be raising funds from multiple venture capital firms. Again, at this point, you're likely to be appointing a lead VC because you have a couple of them, funding your startup, right? Then you have the Series B stage, which is where you're now expanding, either demographically or geographically, and then you're increasing your market share. Then for the late stage, that's where you now have Series C and above, mostly Series C, and that is the stage where the last fundraising stage before you IPO. At this point, you're thinking around expanding globally, or if there's a specific new opportunity you want to explore, or you're trying to put finishing touches to maybe subpar performance before you eventually go for your IPO. So those are the stages in the fundraising cycle.
Wow, that's a lot. And it's good that you mentioned that there are sub stages, right? And,
Yeah.
there are so many founders who just think that, oh, we are raising pre series. So let's just jump into it. A very good
Yeah.
resource or a very good material to actually study is Dr. La Brown's book, Journey to Series A. And you've actually pulled some
Correct.
parts. So you've talked about the fact that there's the early stage. Possibly you've gone past the stage of just your POC and you've gotten an MVP out there in the market, and then you've been able
Correct.
to validate that there is a market that exists for this
Yeah.
solution that we are building. And so right now you are at your validation stage. So you are trying to, so usually people have this mindset that it's idea, is it idea, MVP,
Ideation stage. Yeah.
validation and traction. So
Hmm.
that's like in terms of business process. But in terms of fundraising,
Yeah.
you've done an excellent job in explaining to us what those funding rounds or what those funding stages can look like. And it's very
Yeah.
important to also distinguish. I would like to share this, that a startup is not, it doesn't have the same DNA of a typical brick and mortar. The startup may
No.
have a brick and mortar building, but the DNA of a startup is different from an
Completely
MSME or a
different.
business, right? Because you are
Completely
not,
different from an SME.
your growth is different, right? The kind of factors that identify what growth means for you is different from an organization that is doing it the MSME route. And it's important that founders are able to distinguish, because there was one contention as to what is a startup. Someone said a startup is a business that is starting. That's a very what's the word, basic definition,
Interesting.
right?
Never heard that
We have
before.
the Nigerian Startup
Interesting.
Act that has defined what a startup is, and two major ingredients of a startup is technology and continuous innovation
Exactly.
and
Exactly.
scalability, right? And
Correct.
scalability doesn't mean that we are now building buildings in different countries. It means that
No.
the technology that powers the solution is scalable infinitely.
It's
The
scalable.
emphasis on
Yes.
infinitely, right? I could go on
Yeah.
and on, but let's go to the next my next question for you, which is
Yeah.
very, very important. How what are so you've talked about the stages now. Can you explain what are some of the funding options that startups have, and of course potential sources of those kinds of funding, so that if there's a founder that's going to be watching this video sometime in the future, they're like, okay, we're looking for funding, based on where they are, what kinds of funding should they look for, right? Based on your experience, right? I saw the huge numbers in your profile and I'm like, wow, God, when? But yeah, possibly explain to us, what that those sources of attraction look like, funding options available, and of course potential sources of funding in that regard. Thank you.
Okay. Thank you. Well, that startups or founders explore. But in this part of the world, I think everybody is focused on VCs, and I'll list a couple of them. So we have the personal source, which includes founders putting in their own money or raising from personal friends and family or relatives. Then we then have the angels, and the angels are wealthy investors or wealthy individuals who have significant amounts of disposable income, and they are looking for investment opportunities. So that's another major source. Then another source of fund is family offices. That's not so common in this part of the world, but I think we are beginning to see an uptick of that activity there. Then of course you have the incubators and accelerators like the ARM Techstars, ARM Lagos Techstars accelerators. Then of course VCs, which everyone is very familiar with. Then PE firms, private equity firms. But like we all know, the private equity firms are mostly focused on the late stage startups. Then we have crowdfunding as well. I mean, we're shocked at the number of founders who default to that and have been able to raise significant amount of money, through crowdfunding channels. And then, of course, grants and awards or government subsidies. And then the final one, which a lot of founders don't like to talk about, is loans. But I mean, that's a source, you know. As long as you need cash to run your business, debt is another veritable source of cash too that founders can explore.
Solid stuff, solid stuff. And I think it's important to know at what stage you need what. And a lot of people don't understand the fact that you can't just start a business and the moment you are going to a venture capital investor, because different
Correct.
VC organizations have different metrics that they use to judge or determine when they're going to enter. So there are some. So for example,
You're
right?
so right.
I'm speaking from experience. I work with Google now. In a capacity as a mentor in its Google Black Founders Fund, and of course it's a digital program. And Google is not going to give you money, at least based on the BFF fund, to fund an idea that you got yesterday. They are
Nah,
literally going to be
nah.
looking for some level of traction in USD, right? To
Correct.
be able to put
Correct.
in money. That's an example of an
Correct.
accelerator, because Google is an accelerator program,
Yes.
right? Because they
Yes.
give grants,
Yes.
they also help with mentorship. One thing is that, so you've also mentioned grants, right? Grants are very, very easy ways as a founder
Yeah.
to show
Yeah.
that resilience and to show proof that people
Mm-hmm.
believe in what you're doing and can put their money where their mouth
Yes.
is. I'll share a personal example, right? Um, Beyond just being a lawyer, in 2020, I co-founded a legal tech company. And we went at first, the next thing we did was not to jump and start looking for funding, right? We needed to prove that we had a workable solution and a product. And we applied for grants. There is no single grant I did not apply for. And we won one, right? At least we won some couple of thousands of dollars just the basic steps, right? So grants are very good ways at very
Exactly.
early stages to show
Yeah.
that, yes, you can run. As you begin
Yeah.
to increase your customer value, as you begin to, build your product more, get into the market more, of course,
Grow
then
up.
you can move from grants to now getting angel investors, right? Like you rightly mentioned, you've talked about family
Yeah.
offices too, not so popular
Yeah.
in Nigeria, but of course, in other
Yeah.
jurisdictions, that is also ways that you can get into LPs and
Raise
you can do
funds.
that, and angels, VCs. And then one last thing before we go to the next question, there's a difference really between venture capital and private equity, right? Venture capital is
Correct.
like, we understand that if we pump you guys with money, you will still fail. But we believe
Yes.
in you enough, and we are willing
Yes.
to take this heavy risk at this early
VCs are the
stage of your
risk
company's
takers.
life cycle. Exactly.
Yes.
Right. And then we're able to do that. We definitely will talk about that more. We are 17 minutes to go. We have a very short time. Right. So I'm curious. You've sat and you've made decisions sitting on the side of a consultant to start up companies and founders. I have as well. So I have my experience, you have yours. From a bird's eye perspective, both from an external consultant and sometimes when you're playing even inside those businesses, what criteria, right, do investors typically look for when evaluating a startup for investment? Very interesting question, right? Because
Very
we did see a lot of things happen. So I'm curious, like what do investors really look for when they're trying to like think of startups to actually fund?
Yeah, I mean, thank you for this question because it's an area that a lot of founders are not very familiar with. So, one key thing that investors look out for is traction, particularly in this season. Traction, with respect to what number of customers do you have, at what rate is your customer growing month on month? How many paying customers do you have? What's your revenue growth rate? I mean, this proves the viability of your idea, of your business. I mean, if there's no traction, you don't have a business yet because there's no evidence that you have a business. So if there is no substance behind what you're doing, or there's no evidence that you have a business, what then is the investor putting his money into? Nothing. So the first thing really is traction. Then the second thing is opportunity size. And by opportunity size, I mean, what's the market size? And then again, what is the market direction? So how big is the market? Because this eventually dictates the scale to which your startup can grow to. This dictates the size to which your startup can grow. And of course, how fast you can grow. And then opportunity size, therein you also talk about, are you launching too early, or you're launching too late? Then the next thing we look at is a team. what is the composition of the founding, team members of the leadership of the company with respect to subject matter expertise, and then what kind of experiences do they have, and the depth and breadth of their professional network as well. Then another thing we look at is at what stage in the development of a product or solution is the company. Are you asking for money when you don't even have anything yet? How much of your sweat do you have in the equity? How much of your blood have you put in the business? So if you have not put in your blood, why would you expect an investor, to put in his blood? Then the next thing we look at as well is competitive advantage. you know, what would make you succeed in the midst of competitors, in the midst of competition? Is your competitive advantage um, led by your business or dictated by your business model? Is it business model led? Is it pricing led? Is it the kind of technology you are delivering to the market, or is it network effect that you're leveraging on? And then another side to your competitive advantage is how replicable is it? Is your competitive advantage the kind that your competitors can easily copy? If that's the case, that put some sort of dent to your chances. And then finally, but not exhaustively, distribution. What distribution channels do you have, to get your solution across to the market? If all of these things are in place, but the customers don't know that you exist or are not able to access, your solution, you still don't have a business. So what distribution channels do you have? Are your processes repeatable? Are they scalable? Do you have recurring earnings? What structures do you have in place to automate recurring earnings and things like this? So these are some of the key things that investors look at before even deciding to say, okay, this, founder, this startup is worth my attention, is worth my money.
Wow, that is wild. Oh my God. Like, you see what you said now is an entire masterclass. Because every because every single subhead has branches, right? Let me just pick
Yeah.
one. A business or a startup that does not have paying customers is not a business. You're opening a charity organization,
You are not a
right?
business yet.
If you don't have skin in the game, like investors want to see that you're not, this is not a cash cow,
Yeah,
because entrepreneurship is hard, building
it is.
business is hard. So
It
we are
is.
not looking for people to fund, we are looking for solutions to solve. And
Correct.
something that's very, very important about the knowledge of the venture capital space is that, according to some data insights, it's been proven repeatedly that venture capital is an area or a sector of society that can be used to trigger economic growth. So investors are
Correct.
very keen to businesses that are solving problems that, if they scale and they scale properly, can give a huge number of economic impact, positive economic impacts, right? You've talked
Yes.
about,
Yes.
the model of the business. So investors are looking at the model of the business. I dare say investors are also looking at the team. They want to know who
Correct.
is on this project. They want to know
Absolutely.
your
They are the
track
brains
record.
behind the
They want to
business.
know your
Yeah.
history, right? I'm not trying to glorify failure, but investors want to see that you've done a couple of things and you've learned a couple of lessons, right?
Yes.
Contrary
Yes.
to what common belief may be.
You've developed
We are not
skin.
saying that you must be successful, you must have had a successful history, but you must have a track record of
Should have a
starting
history.
and completing things, right? So
Yeah.
they're looking for character. They're looking for strategy. They're looking at your operations. I would dare say, I'm
Correct.
a lawyer, I'm very biased. I'm sorry if you're on this call. They are looking at your internal framework and your corporate governance structure. Because we had issues where we had some startups shut down because they falsified customer and client records, right? So,
Sad.
the thing is,
Sad.
the wool has been pushed back investors' eyes, and they are no longer just looking
Yeah.
for, oh, we have a beautiful product, this is a solution,
The
we are going to market, and we are valued at $10 billion. That doesn't fly anymore, right? That is why due
substance.
diligence, exactly. That's why due diligence and investor readiness has become a critical part. Guys, if you're watching this live session, I implore you, right? Because we are going to end in a bit, but you need to go back and listen to some of these things and share with a founder, share with, if you're an investor, please listen. If you're someone who deals in the VC space, please ensure that you do this, right? So let's go to the next question. So there are some certain documents, right? There are some certain things that these businesses need to have in terms of preparing themselves to attract. It's one thing to have those, like you said, you can have all these documentations, but if you don't have a customer, you don't have a business, right? So the question is, how do founders and how do business owners attract investments, right? What are some of the documents that they need to put in place that will be like, okay, we're seeing some signs of life, and then we can move to like the last three questions before we run off again. Yeah.
Okay. When it comes to documentation to attract businesses, I mean, financial statements very key. Investors wants to see your financial history. They want to see your profit and loss statement. They want to see where you're spending money. They want to see how well you manage money. They want to see if you have how well have you managed your money, because that gives me an indication of how you would handle my money. So they want to see things like that. They want to see your budget, your projections. They want to see your business plans. They also want to see your contracts with suppliers and with your customers as well. Are you disadvantaged in the kind of contract that you signed? What kind of commitments have you made that has already put you at a disadvantage, which will then affect the investor, when they come in. I mean, the investor wasn't a partner at the time you signed those contracts. So why would I want to put myself into a disadvantaged position when I can avoid that? So they want to see those kind of things. Then with respect to legal documentation, I mean, you're talking about tax documents. I mean, that's a big thing, in the in with VCs, a very, very big thing. Then partnership agreements, and maybe partnership agreements with other VCs or other investors as well. Then your registration documents. um like you said, founders can front or claim something, but in reality, there's something else is going on. So they want to really see, what is this business? What does this business look like from the legal standpoint? Then, do you have any intellectual property rights, any patents, any licenses? Do you have those documents in place? They want to know if you have even properly filed, or if there's a potential lawsuit, if because you've not tidied up some things. Then, of course, lawsuits, present or past. What are such things? If those things exist, they want to know, again, to protect themselves or know what to expect when they come in partnership with you. I mean, there's several other documentation, but these are just a few of them because of time.
Yeah, of course, definitely. So you've mentioned a lot, and I think that it's a healthy way to actually checkmate and do. So when investors are conducting due diligence, it's not just your numbers; it's also your history.
Yeah, yeah,
Anybody can put a deck or a business plan together, but you cannot. The reality of things is that there is a certain pattern of doing business, right? And your patterns will show in your documentations. So whatever it
correct.
is, and you've mentioned some very important things that have to be done, because if you don't, you are going to run a risk of not being able to justify your ask. I remember a
Correct.
particular time where we had to do some due diligence on a couple of companies, and they were asking for a particular amount in funding, and they were asking that amount as a particular valuation. And one of the things that we needed to now track was their funding plan,
Mm,
right? So,
yeah,
even if you are going to ask for money, what are you going to use it for?
exactly.
And it was not just about bullet points, marketing and research, my research and development, building a team, employment. No, very specific things as that you are going to be
Yeah,
using those funds for, and how they tie to your overall company's objectives, goals for growth
correct.
and profitability.
Correct.
So it's not even
Correct.
just about just having lofty ideas of what that funding is going to look like. And investors are really critical about this because they need to track
Yeah,
what the money they are giving you is going to be used for.
correct.
That's the
Correct.
only way it's
So
going to
true.
work, right?
So true.
Yeah. So I love that. We're going to go a little bit technical, right? We are 30 minutes. We have possibly like 15, right? 15 or 20 minutes to go. So you and I were at an event, right? And we had massive game ecosystem players in the building. And
Yeah,
this space is very beautiful. Everybody likes to network, everybody likes to meet the other person because everybody seems to be doing amazing in the ecosystem, right? There are strategies to attract funding beyond just doing good work, having good clients, and having good customers. I think networking is a very important part.
so true.
Um, so, and I will give a typical example, right? My first or earliest funder came from an event where I networked, right? And networking is not just exchanging complimentary cards. I don't want to
Mm-hmm.
do a
Mm-hmm.
whole mental master class on networking because we are talking about investment and all that, right? There's a
Yeah.
certain way, and there's a certain posture that startups really need to adopt if they are going to be attractive to investors, right? So I don't know, based on your experience, right? You've legit led teams to deliver results in revenues in millions of dollars. So I want to ask, what role has networking played in that process, and how important is it for startups that are actually seeking investment to what's the word to attract investors, right? By networking. I would love to hear your thoughts about that because it's something that a lot of founders like to do. Every event, every tech conference, you in fact you can have like 20 tech conferences in 3 months. So please,
Yeah.
how do we get the best from these events, right? As founders, and if you're a founder out there, a professional, you want to, get an investor. What's the best strategy to go about with?
I mean, networking can make all the difference in your business because the money that you're looking for or the resource that you're looking for, is in the hands of someone. So you cannot but network and meet with people. And because the funds you're trying to raise, you can either get it from someone you have a direct relationship with. Like I said, there's 3 hours, to networking. Raising funds through networking is that you have the direct relationship, or somebody is recommending you, or somebody gives you a referral. Those are the three ways: recommendation, you have direct relationship, or referrals. So you cannot discount the place of networking and building relationships. And then when going to networking events or you're meeting new people, one thing I recommend, strongly recommend, is every opportunity you have as a founder, yeah, do something that I call a micro pitch or a soft pitch. You know, like a casual conversation with whomsoever you're talking to, 1 minute, 2 minutes. Just quickly share your story, share your journey. Of course, you're not asking for money, but share your journey, share your story, with particular emphasis on
Don't worry, Gabriel will be back, right? So he's saying that we should share our journeys and ensure that we micro pitches, yes, always works in very interesting circumstances because at the end of the day, you want to be sure that you are telling a story. I realize that most of the people, for example, if you watch what they call them, Lions Den, right? You realize that the captivating story of people usually makes these investors like, oh wow, this person. So investors are very, very drawn to people who solve a problem that they are in touch with, right? So that storytelling part cannot be overemphasized. So right, it's very important to know this because by the time you have to stand before your customers, everybody's a salesperson as far as building a business is concerned. Yes, I understand that your title is a CTO or a CEO or a CFO, but you're a storyteller because you are telling the story of someone and you are trying as much as possible to make a difference, right? So Gabriel is back. It was an interesting break, but yeah, welcome back, Gabriel. Don't worry,
I'm
we
so sorry.
understand. It's fine. It's fine. We understand.
Yeah, so I was talking about at every opportunity, just do like 1-2 minutes, micro pitch, to whomsoever you're talking to, with particular emphasis on sharing your thought process,
Yeah,
how you think, how you do your things, and then share your values, your ethics, share your passion, share your vision. And this does two things for you. Number one, you never know who will connect you with the opportunity you're looking for.
yeah,
Because if you already share these things, if someone wants to make a recommendation, they have the parameter, the data about you, to
yeah.
match you correctly with someone else. And then the other good thing it does for you is that these are opportunities for you to fine tune your pitch, so that when you eventually
Mm.
get that break, you already know what to do. You already know how to, to run your pitch. So yeah, that's the way to go when it comes to networking.
I love it. And before when you went off for a little bit, one of the things I emphasized was the fact that investors are attracted to stories. Investors want to know. Founders want to know that you are in touch with the problem that you are trying to solve. They
Okay.
want to know that it's not just one money making experience for you. They want to know that you have realized that there is a deep need, and because of your resilience, right, you've been able
Yeah.
to craft something to solve that need. It comes from
Yeah.
within. So I will also, the last thing I'll say about on this networking, please be authentic. Be very authentic,
Right.
be genuine.
Yeah.
Don't
Be
Everybody's trying
genuine.
to be somebody
Don't
these days.
fake it.
Please, like we can read through. I'm sorry for using the word. We can read through the BS. We know when you are not real. That's the truth. Be
Investors
real.
see all sorts of
They
people,
see,
hear all
and
sorts
what
of
they need to do
things.
is place a call.
So
Like, who is this person behind
who
the
is this
scene?
person? That's about it. Yeah.
That's it,
Be
right?
real.
Very, very
Be real.
important that you mentioned that. So to my next
Yeah.
question, right? Um, Now you've talked about different stages. We've talked about the life cycle, because there's a stage where, as a founder, you are bootstrapping, and then you start seeking external funding. Of course, there
Yeah.
are pros and cons of this, right? I have seen and I've heard the story of builders and founders who did not raise external funding until they possibly got to the seed stage, right? Series A or something,
Series
and
A.
they are
Yeah.
very few and far between. What do you think are some of the advantages vis-a-vis disadvantages of bootstrapping? So for those of you on the call who do not know what bootstrapping means, it simply means using your own personal resources, right, to build. So possibly everything is coming out of your own pocket, and usually this happens very, very early in the stage of your business, right? What are some of the advantages and disadvantages? And what would you think is a healthy balance between both? Is it something, do you just start your business and start looking for funding, or do you need to actually show that proof of work by putting your own financial commitment in the business before you start looking for those kinds of funding? So I'm curious to find out from you. Thank you.
Very good question. Thank you. So I think one of the major advantages of bootstrapping is that if you're able to successfully do it, and like you said, maybe up to that Series A stage, it gives you leverage when you are engaging VCs if you eventually decide to raise funds. And leverage is something very few founders have when they are, discussing raising funds. Very, very few founders have leverage. So, but when you have bootstrapped your business and you're engaging investors, it's a conversation. Nobody's questioning you because your business in itself is proof of every, you know, answers all the questions that any investor may have. So you want to talk about traction at Series A, you have that traction. You want to talk about product market fit. I mean, your business is living proof that it's either you are in or out. It's either you are interested in investing in it or not. It's either your value system aligns, your investment thesis aligns with the founder or not. But that you are asking questions or scrutinizing that business. I mean, as a bootstrapper, you've gone past that stage. So at the Series A stage, what you're simply just doing is let's just go straight to the point. This is what I want to raise. This is what I want to do with it. Are you interested in it or not? So you have leverage to negotiate, very decent terms for yourself. Now that's one of the major, pros. One of the major cons is um in all sincerity, and founders probably don't like to hear this, not everyone has the intestinal fortitude to bootstrap. It takes a lot of might, strength, internal strength to be able to do that because you are contending with all sorts of forces, market forces, customers, all sorts of things, and even your own internal dialogue. You are contending with that to prove something, and it takes time, 2 3 5 years, before you're able to get to that point where you can say, okay, this I have built substance. I mean, how many founders actually have the strength to wait that long? So that's one of the major cons to it. And then when it now comes to raising VCs, raising funds from VCs, especially when you're raising very early at pre-seed stage or seed stage, my recommendation is don't do it if you haven't built something. If you're a second or third time founder, I mean, excellent. You have a track record. So if you are launching a new startup as a third time founder, I mean, the industry takes it for granted that you know what you're doing because you have track record. I mean, at the end of the day,
Okay. So I'm sure that's in this. Don't worry, Gabriel will be back. So I think one of the things he was trying to articulate was the fact that, yes, sometimes bootstrapping is not for the weak, to be very honest, right? And so even if you are not bootstrapping in terms of your money, you are definitely bootstrapping in terms of your sweat. So possibly you are more or less like a technical founder. So you are literally doing the work, you are building the product itself, right? So that's something very, very, very important and crucial that you could be doing, right? But when you get to the point where you've been able to show yourself that you've been able to build this thing from just a thought or an idea to a living, breathing product, at that point, yes, you've been able to show to some certain extent that yes, you are very, 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 very intentional about what you're trying to do as a founder. So it takes a lot of, yeah, it takes a lot of, and of course the pros and cons of it is that yes, you can negotiate your terms. If you are a bootstrapper, definitely, when someone comes to you and gives you an offer that and I would share a very interesting example, for if anyone who has heard the story of Piggy Tech, you realize that they bootstrapped for, I think Odun mentioned about 3 years before they even started thinking about for now. Not everybody may be able to do that, but that really put them in a very, very good position where they were able to show and able to get very, very, very good things or good terms, before they had to now start like raising funds. Because it gets to a point where there's only so much you can carry as a founder. So it's something that's very, very important to realize. And you do not always have all the answers figured out, at the beginning. So, sometimes putting your skin in the game is also a healthy way to be able to identify the industry, look at the challenges that you are also facing, and then you can be able to identify that, okay, fine, we tried this before, it did not work. I don't think this is what we're going to try again. So yeah, very, very solid thoughts. While we are expecting Gabriel to join us, which I know he will very soon, I would love to talk very, very importantly about some of the due diligence processes, right, that investors really undertake when they are trying to, invest in companies. Okay, Gabriel is back. I think that's even supposed to be like our next question, but we're about rounding up. So at this point, if you're here, please start putting your questions down. And of course, if you have questions, you can send them Gabriel's way. I promise he will not charge for your first 3 questions, but I cannot assure you after. Same as myself, right? So please just round up your thoughts so that we can move to the last question, and then of course we can shut it down for Q&A. All right.
Yes. So like I was saying, if you want to raise funds as a founder at the pre-seed or seed stage, I recommend that you do that if you're a second or third time founder, because you've already built credibility, you've already built substance, and investors already have answers to the potential questions they would have been asking, at investors meetings. So that's my recommendation.
Awesome. So I was about to go to the next stage. I was about going to the next question, which will be like our second to the last question, or possibly our last question, talking about some of the I was trying to wear the hat of a lawyer in this conversation. Some of the due diligence processes that investors undertake before investing in a startup, right? So usually it will go something like this. They would want to request your company profile, business documentations. You had mentioned earlier your financial model. They want to be able to see your go-to-market strategy, your POC, proof of concept, and of course, not just the working MVP, but possibly feedback. You said something very important about service level agreements and possibly standard operating procedures that your company already has in place before trying to bring those things on board. Let's pick one last question that I think should round off this conversation, and it's about exits. The VC space is a very interesting space. The VC space is not investing in Nigerian stock exchange, right? Where you are getting dividends, or is not you are giving a loan. There are so many ways you have to raise funding as a founder. Possibly you're going to
Yeah.
give equity, right? You're going to give equity
Yes.
at some point, whether it's in the
Yeah.
form of employee stock options, whether it is in the
Definitely.
form of just direct equity, which would convert by virtue of using safe agreements, whether
Yeah.
it's you get a loan through a convertible note, which converts into equity, and then you are paying interest. There are so many funding options that different founders have to use, and many times it can be very confusing as to what are some of these options that they can do. But let's talk about what are some of the ways investors who put monies in can exit, because there's something that my first boss will always say. begin with the end in mind. The venture capital space is not a make it quick scheme. You can have, that's why they have a pool of funds that plug in, and sometimes they don't reap the rewards until 10 years after, right? Because of how the company must mature to a point where beyond just being valued at $1 million, it's now valued at $1 billion, right? So you need to be able to understand as an investor, and this is to the investors in the room, that if you are going to be putting VC money, you cannot call them next week and say you're expecting profits. It doesn't work like that. So what are some of the ways that, some of the exit options that are available for investors who come in, and how can startups manage their finances so that they get to that point where they are able to successfully exit? And what does exit even look like in the startup space? There are so many questions, but I'll start with this. I'll end with this last question. Yeah.
Okay. When it comes to exits, one of the viable options for investors that come in early in startup is actually the secondary market. There are investors who would want to buy up your space, buy up your shares, and so you can trade places with those kind of investors. It's not a very very um, big space yet, particularly in Nigeria. But I mean, we are beginning to see again an uptick, in activities along in that space. So secondaries is one major, options. Then PE firms, like we said, private equity firms, they come in at later stages. So those are also potential buyers of your shares and your stock, when you invest in companies. So I think those are the major. You asked one other question around
Yes. What I
um
was talking about, how the startups can manage their finances and runway to successfully exit. Yeah.
okay, very good question. I mean, manage your cash flow.
Mm,
And the two critical ways to do that is: number one, manage your expense and boost your revenue. It's cash flow you're looking at.
mm,
Manage your expense and
mm,
boost your revenues. So when it comes to expenses, I recommend three things: brutally audit your spending. I
mm.
repeat, brutally audit your spending. There are lots of things that you spend money on, you think they are necessary. You'll be shocked that when you pull the plug on that particular item, your business still continues to run smoothly. As long as you can avoid that spending, avoid it. Then negotiate recurring expenses or seek alternatives. So if you have, subscriptions that you're paying for, whatever kind of recurring monthly recurring expense, try as much as possible to negotiate those rates and bring down your expenses. And where possible, look for alternatives, cheaper alternatives. Then also prioritize and delay spending as much as you can. Prioritize and delay spending. There are some spending that can wait. For those that can wait, delay it until cash comes in. Then, of course, improve on sales to grow your revenue. And likewise, negotiate better cash collection terms with your customers. So if you're doing credit sales, for example, negotiate better cash collection terms, because cash is what you need. So you need to negotiate those terms that help you have more cash, in your bank account. So those are my recommendations.
Awesome stuff. Awesome, super awesome stuff. And I also like to add to that, have a funding plan. See, let's not even just joke about this thing, because when people give you money, it has to have a goal, right? I love the fact that you talked about brutally, right? I don't want to call names, right? But there are some startups that we know based on you're laughing. Maybe it's inside gist, but there are some founders that we know. There are some certain amounts that you should not be burning monthly in the name of your salary,
Nah,
for God's sake,
nah,
at a
nah.
particular stage,
It's
right?
it's it's it's
And sometimes you're like, because this money, whether it comes in bulk, right? It's not free money.
it's
There's
not
a
free money.
goal for it, right? There's a goal for it. So I always like also like say, have a funding plan and let your spending match your objective. If there is another thing that founders don't, I think, also need to do, is constant communication with their investors. You don't just get money and just log out, right? because you must guide your
Touch base.
founders, you must guide your investors through, especially when by the time they come into your company and they get on your cap table. What will you basically see happen is that they will either have representatives on your advisory or on your
Yeah,
designate board, right?
yeah,
And
yeah.
they would now have to start overseeing and monitoring decision making processes within your company. Don't be a company that does not have corporate governance in place. There's a reason why that principle is important, because it
Correct.
acts as a check and balance to the
Yeah,
management,
yeah,
shareholders, and the board, because it's a triangle, right? Your
yeah.
shareholders can come as your people who are listed on your cap table, people who are
Mm-hmm.
basically pumping in money into the company in
Money,
one form or the other, whether
investors.
it is in capital or
Mm,
it's in sweat. They're your shareholders. And then you have
yeah,
your management team, your C-suits, right? Those who are in charge of the daily decision making of the company. And then you have the board. That triangle has to constantly interweave with one another through communication, through being able to ensure that information is passed across, through having ethical conduct and behavior within the organization, because it is good to know the books and it's good to know the numbers, but what are the company's ethical practices, right? How are what's the word, books valued? How are they audited? What's the process for decision making? Does the CEO wake up one morning and decide that today we are pivoting from agriculture to health? The scandal that happened with Enron was that they started as an energy firm, right? That was supposed to, in one way or the other, collaborate with the private sector and public sector to give electricity or something. Then, before you know, they began to tokenize electricity. Who tokenizes electricity? The business model was not modeling. And then, because of the pump and dump of figures from a very minimal or regular or normal share value, the share value rose at a particular time to about $99 per share, and that was like the highest in
yeah.
US financial history.
Stock
And then in less than 3 or 4 months, dipped
crashed,
down. People committed suicide,
crashed,
people lost their jobs. It was
crashed.
bad, right? So
Yeah,
when we think about building business, let's realize that we must begin with the end in mind. Successful exits, I would round off here
yeah.
because we are way past time. Also deal with, of course, liquidation events. So where you get to a funding round, like a series round or a seed round, where there is an official valuation done in the company. Those who came into the business earlier are able to convert their stake in the company at that current company valuation, or if they had a valuation cap at the early stages of negotiation, they convert their equity value at that valuation cap, and they're able to get more value for the money that they put in future, right? You have mergers and acquisitions, right? They can be bought up. So the typical example of Paystack being bought by Stripe, that was a management buyout or a merger, as you call, not a merger but a management buyout. You have
Yeah.
acquisition happening. You have different things. So there are so many events. You can have listing of an IPO, right? Stock exchange, like what happened to Jumia. I'm happy with where they are
Yeah.
now, that they've been able to stop some of the bleeding that happened within the company, and there was their
Stabilized.
most
Yeah.
recent financial report shows
Stabilized.
some stable growth. So, like I said, it's a
Improvement.
marathon. I think I would
Yeah.
end this to say, the growth and the life cycle and the trajectory of building a business it's a marathon, it's not a sprint. And founders need to understand that they need to play this game for the long haul. Many founders have different reasons why they come into or they build businesses. Some build to sell, it's fine. Some build to create
Yeah.
legacies, it's fine. But however you choose to do it, make sure you do it measurably, equitably, and sustainably. I don't know
Yeah.
what your final thoughts are. I don't know if there are any questions. I know I asked if questions were going to come in the comment section, but if we don't see them, we'll just round off, and you can always shoot Gabriel your questions. I told him only 3 questions. After 3 questions, you will have to charge per question. But yeah, so do you have any final thoughts for us before we round off?
Yes, I mean, this is just a final word to founders. I mean, keep hope alive. Things are tough. We understand that, but build your business. Like I say, build your business with a conscience. Run your business with a conscience, and when you do that, every stakeholder in the ecosystem can see that. And when you are upright, like you said, establish and run your business equitably, sustainably. The system would come around, always come around to support.
Yeah,
So
yeah.
that's it for me.
Thank you very much. And let's not forget, yes, things may be looking red now, but there's always light at the end
Yeah.
of the tunnel.
Yeah,
It
it's a
will
cycle.
shock you to know that investors are
It's
looking
a
for
cycle.
companies to fund right now at very
It's a
good deals.
cycle.
So if you're a founder on
Yeah.
the call, position yourself properly, make sure you have your documentations and everything you need in place, ensure you are meeting the right people, you are positioning yourself in the market. And then if you are an investor on the call, we have very solid businesses coming on. Ensure to do the needful and the proper due diligence before you plug in funds. And of course, Gabriel and I, we're always here to assist. You can go through our LinkedIn profiles.
Always here.
They're, of course, always here. Gabriel runs Plumul Advisory based on his vast years of experience in this space. He's somebody that can provide counsel as well as myself. So we're looking forward to seeing you on the other side. I just want to say a very big thank you to you, Gabriel. Thank you for this sacrifice. You and I know what know what the sacrifice is. So thank you
It's a
so
lot,
much.
but we have to do
I'm
this.
telling you, thank you so much for spending
Thank you.
time
Thank
with
you so much for
me.
having me.
I'm very excited. I'm sure that our
I
viewers
really
had so
appreciate
much
this.
value and we are so excited. We look forward to coming your way at the next Startup Compliance series. Have a very, very good evening and bye for now. And have a very good evening,
Thank you so
Gabriel.
much. Yeah. Bye bye.
All right.
Bye bye.
Bye.